Hello, and welcome to another quarter from Horizon focused on our quarterly review and market outlook. My name is Austin Fitch. I'm joined today by our CIO, Scott Ladner, and we're really excited to have you joining us as we go through really what happened in the second quarter, which, as crazy as it may seem, Scott, we were together just 3 months ago today, talking about kind of some of the chaos that existed in the marketplace. So there's a lot for us to cover today. Actually, we've got a full agenda, as we can see here, that we're going to touch on a number of different items that are going to kind of get us through the second quarter, but then it's also going to get us into what we see for the back half of the year. So without any further ado, I will say this. If you have questions, don't hesitate to put them in the chat. We will try to get to as many of them as possible as we go through today's presentation. If we don't get to your questions, please don't hesitate to reach out. We'll be proactively reaching out as well. But we want to make sure we get all the questions answered. We know there's a lot going on. We know you're probably getting a lot of questions from your clients. So we want to make sure we get to those as quickly as possible. But without any further ado, we will get started. And Scott, we kind of jokingly make the reference. We're talking about AI again, and I think we've got a great slide that kind of speaks to the fact that, man, we've been talking about this for 2 years now.
Yeah, this is kind of the Back to the Future slide. We started talking about AI publicly to clients and investors about a little over 2 years ago. It was in our June webinar in 2023, and this was a slide that I used to kind of just set it up because it was. If you remember, this is kind of when we're trying to figure out, is AI really a thing? Is it going to be the real deal, or is this going to be kind of like crypto, blockchain, Web3, sort of like flash in the pan? Don't really know what to do with it. Seems kind of cool, but like I don't know. And we were making the argument back then, and we're obviously going to continue to make the argument today that it is the real deal. This is much more like the internet revolution, the internet PC revolution of the mid '90s. With respect to this, and most importantly, this last thing, the productivity enhancements that are going to be generated through the adoption of AI and specifically generative AI, and that is, there's going to be, what we think is probably the most important thing economically. It has been for the last couple of years, probably will be for the next few years, and it is it's going to be a fun ride to continue to see, and hopefully we can shed some more light on why we think it's important.
Awesome. No, I think that's a great point to highlight. Hey, here's where we were even just 2 years ago, where we didn't know nearly as much as we know today. And Scott, you touched on kind of generative AI. One thing we want to do today, because we get a lot of questions from advisors and folks that we're working with, is like, okay, what does this actually mean? Like, show us an example of how this works. And we actually found this video that we think it's a quick 2-3 minute video. We think is a great snapshot of just this generative AI conversation and concept, just to put it in the back of your mind, right? To keep in mind, hey, here's how AI potentially is going to be used. As you can see, it's already being used in a lot of cases in very innovative and productivity enhancing ways. So we want to show this video real quick. Then we'll come back and discuss maybe what we saw, but also how it affects productivity. So without any additional items here we go.
So I've seen a few people online using Manus to do things like build a Flappy Bird game or find them rental accommodation in a city. But I wanted to try an example that I thought would be relevant to somebody who probably doesn't have any coding or website building experience. And as a parent constantly on the lookout for great playgrounds, I decided to test Manus from a parent's perspective. I literally gave Manus one simple prompt. I asked it to create a fully functioning website that shows all of the children's playgrounds in Auckland city centre. The website should have a map showing where the playgrounds are located and also a description of each playground to help guide the suitable age for the child using the playground. Manus sprang into action, and what unfolded next was actually super impressive. So I retyped in the prompt, and then I closed my computer and left Manus to operate overnight in the cloud. And when I woke up, Manus had literally delivered a fully functional website highlighting various playgrounds in Auckland with an interactive map, and they were all categorized by age suitability. It had literally done what I asked, and if you want to try it, check out the comments below. I put the public link in there. Now, it didn't include every playground in the area. The outcome was, I thought, pretty good for a single prompt task. And one thing that I love about Manus is it's got a replay function, so you can see what it did decision-making wise and action-wise behind the scenes. And watching this, we can see that Manus started off by setting up a dedicated folder within its sandbox environment, and it compiled a checklist of tasks. So the first task that it took on independently was to do some research. Now, Manus searched the web, gathered data to build its database, and it understood that information structure. It navigated various websites, extracted the relevant details that it needed about playgrounds. Next, Manus established a server environment for website development. So typically when a human does this, they'll find and choose a hosting provider like WordPress, or if they're more technical, they might configure their own personal server. Both of these require some level of technical skill. What I love about Manus is it just goes off and it sets up the server using the environment of its choice, in this case, next.js. It didn't need me to do a thing, which is so helpful for people who don't know how to code or how to build websites. The implementation of the interactive map was another super fun highlight for me to watch. So integrating mapping functionalities usually require installing specific libraries, but you can watch as Manus seamlessly installs and configures JavaScript mapping libraries, Leaflet and React Leaflet in this case, streamlining what would traditionally be a complex process, and it didn't need any input from me at all to do this. Finally, Manus goes off and does some thorough website testing, clicking every link to make sure that they work, and when it's satisfied, it deploys the website, providing me with a public link for access. This level of autonomous operation, all while I slept, was like nothing I've seen with AI before, and I was super impressed. And it's sort of the first time I've seen what looks like autonomous task execution in action.
All right, Scott, so we just took a look at some of this generative AI. Maybe just quick recap of that video. Why is that important? Why did you think it was worth us sharing? Let's talk a little bit about that before we get into this slide.
I mean, I just think it's wild. So we did, like you said, we found this just looking around for examples of like how are people really starting to use this stuff, especially on the generative front, because it is so new and definitely kind of the leading edge of the technology right now. And the thing that struck me about that video, frankly, was just like how simple it was. I mean, it was a one-line prompt, and that one-line prompt made the AI system figure out how to do a gazillion steps and figure out basically not a trivial problem about building a website and sort of like doing the research and testing it, building databases, just doing all the sort of the grunt work you have to do behind the scenes actually to solve the problem that was being asked in this very simple one-line prompt. And that just shows like this is how far and how fast this technology has come already. And we're only a couple 3 years in, and just kind of think how much more productive this can make folks. And we're just using slides like this here to show like how quickly the adoption curve is starting to shift. I mean, just in different obviously things like software and technology are going to be quicker adopters of this type of things than are somebody like legal or in finance. But this is coming across the board. And this sort of the graph on the right is showing like that inflection point of how much more quickly we are starting to adopt just in the year 2025. And this is going to be, this graph is going to sort of asymptotically approach 100%. I mean, the entire economy is going to be using AI at some point. And we think that day is coming sooner rather than later.
Yeah. And Scott, we'll make this comparison, I think, later in the deck, but it's this conversation between the internet revolution, right, in the mid 90s. And to your point, early in the 90s, very few firms used the internet. Fast forward through the 90s, and you saw more and more companies and industries start to pick up that adoption. And that's exactly what we're talking about here, right? I mean, marketing firms, sales, operation, like you're seeing adoption north of 50%. And at this point, what, Scott, we're less than 2 years in, give or take, right?
Yep, we're gaining on it.
Yep. All right, so we hit on the AI, as we said, we wanted to knock that out on the front end, but now we're really going to get into some of the data, and the data on the first section that we're going to talk about is the data about how people feel. And I think we've talked about this time and time again, and we've got our friendly picture to go along with this chart. But I think what you see here is man, people still feel pretty terrible. And that's even in spite of the bounce back that we saw the most recent month in there in June. From University of Michigan does a survey every month. They put it out. Hey, how do you think your financial situation is going to be 1 year from now, right? Is it going to be better? Is it going to be worse? They net it out. That's where we get this data set. And again, generally speaking, the last 30 plus years, folks are pretty optimistic, right? Within the last 5, you've had multiple instances where we've started to be negative. And we saw that, Scott, earlier this quarter even go about it as negative as it's ever been, which just speaks to kind of that level of pessimism that has existed in the marketplace, in the economy, in the investing environment, which then puts a whole different spin on kind of what we're seeing. Throw in the fact that it's this manufacturing conversation. And again, you've just got this overhang that's been sitting on top of the economy for some time now.
Yeah, folks just don't know what to think about this right now. I mean, look, everybody is got ticked off about inflation. Like nobody liked inflation. It was really the first time we experienced that in a couple of generations. And so nobody that was sort of started us down this train of like nobody feels very good about the world. Nobody feels very good about the personal finances. They're worried about stuff. Now you throw in AI and sort of the disruptive technology, and people are just worried that all the jobs are going to be gone and jobs are going to be left. They're going to be these manufacturing jobs, but nobody wants these manufacturing jobs. And so it's just when you kind of put it all together, it paints a picture of folks that are a little bit dour. But I think the averages are messing with us a little bit in terms of this. And so on this next slide, here's why I think these data are really confusing to interpret right now. And by these data, I mean like sentiment data. Like the questions about like how do you feel about the world? How do you feel about your finances? How do you feel? And just since Trump came in and really this is more phenomenal the last 5 or 10 years. It matters a lot more like what your party affiliation is. Like basically your party affiliation will tell you how you feel. And so this has gotten questions about economic sentiment and how do you feel about the world, how do you feel about your finances didn't used to be this stark. But now it's basically if if you're a Republican, you think and you voted for Trump, you think that the world is going to be fantastic. If you're a Democrat and you didn't vote for Trump, you think we're going in the absolute toilet. And it is so stark and so weird and so different, frankly, than the last 30 or 40 years. That I think things like this, where the politics is really invading people's thought processes in terms of their feelings. That is making these analyzing these sentiment data that go back 30, 40 years really tough. And really hard to interpret in my mind. And so we started to have to discount some of this sentiment data, because I just think that if you have these two drastically bipolar groups about they talk about how they feel economically just based on who they voted for in the last election, it just makes the interpretation of these historical averages really challenging. And so there are other ways we can get at this. We'll look at this next slide. And also I think you want to talk about this a little bit, but it is I think there are other ways to interpret some of this stuff and to get at some of these feelings. But I do think we have to sort of discount a little bit some of the sentiment data that we've been getting over the last 3 or 4 years.
Yeah, and I think that's a great point, Scott, because I think what we've looked at internally is to your point, you get these wild swings in some of this, consumer data, and it's really more based on maybe political affiliation or how they feel about a certain situation, and we're trying to really drill into, okay, but how is that actually affecting their actions? And we actually found a question in that conference board survey that we think maybe gives us a little bit more information. And it's, do you intend to take a vacation this year? Right? Like that doesn't matter if you're right, left, center. It's going to be, hey, how does my financial situation look? And is that going to put me in a spot to where I feel comfortable going and spending money on a vacation? And as you see, we come out of 2020. Obviously, you get kind of a pretty dramatic effect there. But as we bounce back, as we sit here today, we're about average over the last 35 years at this point, which tells us that it's not nearly as bad as maybe some of that consumer sentiment data that we just looked at would suggest. It's not all rainbows and butterflies either, but it's also not in the toilet. And I think that's something that is reassuring to us as we start to think about, Scott, as you mentioned, some of the bifurcation of that survey data that we're just trying to deal with from a consumer standpoint. I think that kind of speaks to this idea of uncertainty, though. And Scott, I think uncertainty has been kind of the buzzword, if you will, of 2025. Throw in Liberation Day, throw in tariffs, and uncertainty has been front and center for some time now, and it hasn't quite gone away, right?
No, it hasn't. And look, and that is sort of the word for 2025. I mean, if you want to go back and look at history books, what we're gonna talk about in 2025, at least from a market standpoint, uncertainty is gonna be the word. 20 some years have these words. I mean, like 2020 is COVID. 2008 is financial crisis. 2001 is the .com bubble burst. 2025 is gonna be uncertainty. Like that is going to be the word of the year. And for good reason. Look, I mean, we have obviously a president and administration right now that's engaging in some trade policies and some tax policies and some other stuff that just like it's all highly uncertain, and it seems to be somewhat at a whim sometimes. And Austin, we like as you mentioned earlier, we were on this webinar a month ago or I guess it was 3 months ago now, talking through like, hey, listen, this is a man-made thing. The whole Liberation Day sort of market fiasco with respect to how markets reacted to that event was completely man-made. And the point we were making then was it could be unman-made. We can reduce the uncertainty about this, and it does look like that's the path we're going down. But we have more work to do on that front, and it's certainly impacting how people feel about the world. It's certainly impacting how businesses feel about their prospects. Although I think that is certainly turning much to the better now that we have a little bit of clarity on the tax side of things, with the reconciliation package being passed. But it is we still have some road to hoe on that uncertainty front.
Yeah, no, and that's a great point. And Scott, I think the last couple slides that we've got in this section are going to try and bring home the fact that while uncertainty definitely still exists, we actually haven't seen businesses, specifically small businesses, make any dramatic changes because of that uncertainty as of yet. So first slide we're looking at is an index that we put together, aggregated together from a bunch of different data points from the National Federation of Independent Businesses. They do surveys of small businesses looking at a bunch of different things, everything from compensation plans to pricing to price increases. And what you see with kind of the darker black line is an aggregate view of a bunch of different data points. And what you can see there, right, is, yeah, inflation was a concern in 2021, 2022, and to some extent 2023, but it's definitely normalized, right? And it's this belief that maybe small businesses aren't as worried today as they were, say, 2, 3, 4 years ago from an inflation standpoint. We think that's a huge deal as you start to think about what the go forward looks like. The employment piece, Scott, is another thing. So maybe talk us through maybe the most important point when it comes to uncertainty and the business side of things.
Yeah, and look, if you get the economy, if you get the employment side right, you get the economy right. You get the economy right, you get the markets right. And so one of the reasons why we never saw the recession, like any sort of recession over the last 2 or 3 years, was because the employment side of the U.S. economy was holding up really, really well, and we saw no reason for it to turn south at any point. That is still true today. And so this employment sort of index that we've created has turned south a little bit, but look why the thing that you have to look at why it's turning south is compensation plans. And so what that's telling you is that folks, these are signs of a weakening but not weak labor market. That's the compensation plans going down is saying, listen, employers are saying we don't really have to raise wages a bunch. We don't have to grant these large kind of raises that we did kind of in the post-COVID period for those couple of years. And that is that's frankly probably a fairly decent thing, especially as it flows through into inflation. But this employment picture holding up, and we'll talk a little bit more about employment stuff here in a little bit. But getting this part right is the key to getting the entire economy part right.
Yeah, no, that's a great point, Scott. And I think a good transition as we start to talk about, okay, we've looked at kind of the data associated with how folks feel, right, and how that's affecting their actions. Now let's look at maybe some of the harder data, right? This is kind of what we're calling the real data. This first slide is going to be just output, right? And we've gotten a lot of questions when it comes to tariffs and the economy here in the U.S. In relation to, should we become more of a manufacturing economy? Like, is that something that we should go back towards? And we wanted to highlight, Scott, this slide where it looks at, hey, we're still making a lot of stuff. We're just not employing nearly as many people to do it, right?
Yeah, I mean, look, if you want a picture of productivity, this is what it is. Making more stuff with fewer or the same number of people. Doing the job of making it, and that this is a wonderful thing. I mean, this shows the sort of the dynamicism of the U.S. economy. You can show pictures like this around the world; they're going to be similar. The U.S. is by far the best on these metrics, by the way. But even Europe even looks okay. Japan looks okay. China's data is China's data. Who the heck knows? But ultimately, like, we still make stuff in this country. We just make it way more efficiently than we used to. So we don't have to use the same number of folks to make a Ford that we did in 1950, nor should we. This is a good thing for the economy. It's a good thing for workers. It's a good thing for everybody that we're more efficient in making things, and therefore manufacturing employment has stagnated or gone down over the last 50 years. These are the wages are higher in a real basis, and people are doing jobs that they really want to do. This is good stuff. But I just want to reality check. Like, we still make stuff here. We just don't make it with as many people as we used to, and that's okay.
Yeah. No, that's a great point, but I think maybe we can kind of take it to the next level from a conversation standpoint and say, okay, but if capacity does grow and we do start to make more things even than we're currently making, which to your point, Scott, we're still making a lot. But if you do get that push, I think infrastructure here in the U.S. and really for that matter globally is going to be a really important part of the investment landscape over the next 2, 3, 5, maybe even 10, 20 years, because you start to look at a society, you start to look at a structure where we need those component parts, right? We need the infrastructure to be built to allow for us to make more things. And that's an area that I would tell you internally here at Horizon, we're very focused on. We see a great opportunity there. But that's something that maybe we feel has been a little bit underappreciated as you start to look at market dynamics. So this looks at kind of what's called an industrial renaissance basket of stocks relative to a broader kind of technology-focused NASDAQ basket. And I think what you see is over the last, let's call it, 15 years at this point, it actually hasn't done nearly as well as the broader kind of NASDAQ index. And I think that's something where we think there could be this shift over the next little bit from a market standpoint as the market comes to terms or comes to grips with the fact that, hey, if we need this infrastructure, that build out is actually going to lean towards a certain area of the market, maybe that hasn't gotten some of the benefit over the last, like I said, 10, 15 years. So an important point, something that we're looking pretty closely at here at Horizon, pretty excited about. And if we talk about excitement, Scott, I can't believe we're, almost 20 minutes into this conversation and we haven't talked about the new tax bill, right? And I think that's something that we got to hit on. We're not going to spend a ton of time. I'm sure there may be questions coming. But Scott, talk us through this big, beautiful bill that we all have heard about, and maybe tell us where we think, it has an impact on the economy and on the markets.
Yeah. So look, the ABBA was signed into law, a couple of, on the 4th. And I do think there's some things in there that have not been fully appreciated by folks. One is all the sort of depreciation expenses that are basically changing the law about how you can deduct CapEx. What ultimately what's going to end up doing is driving a lot more CapEx in the United States, which by the way should help infrastructure. But at the same time is also going to really productivity enhancing for the medium and the long term. And it can offset some of the tariff costs that are, if we do end up with these, we are going to end up with higher tariffs. It's just how much higher tariffs we're going to end up with. And those, the provisions inside of the ABBA are going to be helpful towards offsetting some of those things. And it could actually drive the effective tax rate for U.S. corporations down in the low teens. The statutory rate's not changing. Obviously in this bill, but if companies actually take advantage of some of the depreciation aspects of it, it could drive the effective tax rates for U.S. corporates and down to levels we haven't seen for quite some time. And that's obviously highly stimulative for the economy.
No, that's a great point, Scott, and it kind of feeds into this idea of growth across the economy, and wanted to show this chart just as a refresh. I think we've shown some version of this chart multiple times over the last few quarters, and it just looks at GDP. And we've got a lot of questions from folks about, well, GDP is collapsing, right? We should be worried we're headed into a recession. And I think collapsing may be a little bit of a strong term or a strong way to look at it. I think it's a normalization, right? We've talked about this fact that coming out of COVID, right, you had this spike in GDP growth over and above anything that probably anybody reasonably should have expected. We've seen just over the last 5 years this normalization, right? And we've highlighted kind of that band right there in the middle of a 5% year over year kind of GDP growth rate. And as you can see, going back 30 plus years, that really is kind of that normal growth rate. And you can see right now we're just right smack dab in the middle. And if that's the case, we think that actually paints a pretty good picture for a go forward basis. Scott, it also dovetails perfectly into kind of the corporate revenue and the growth of that. As you start to talk about kind of economic growth and corporate revenues, they tend to tie together pretty closely.
Yeah, they do, and they should. And it's probably no surprise that the corporate revenues, which are nominal figures, obviously, is kind of tracks with what nominal GDP is doing. I mean, GDP data is ultimately company and personal data, and so there's sort of an identity aspect related to these two charts. But the important point of this chart, what I really want to show here is that when you have strong corporate revenue growth, when you have corporate revenue growth that's growing 4, 5, 6% year over year, you don't fire people. Like corporations don't fire people on en masse when their revenues are growing 4, 5, 6% on a year-over-year basis. You just don't have to do it, especially when you have a time that coming out of COVID where folks had a really hard time hiring people. So they're just going to be rather loath to fire them. And so that the next page has some of those data. This is in terms of like companies saying or mentioning layoffs on company calls or management talking about it. We're just not seeing it. We're not seeing it, and nor do we think we're going to see it, because we do think the economy is going to continue to just chug along here. Like it's not, this was kind of a 6 out of 10 economy. Maybe you get to a 7 out of 10 economy. It's not 2 out of 10 economy. This is still an economy where corporate revenues are growing pretty strong. Nominal GDP growth is coming along around 5%. It's sort of normalizing around there. And you've got companies that don't want to lay people off because they had such a hard time hiring folks after COVID, that they're just, they may slow down hiring, which is what we're seeing in some of the data, but they're not actually laying folks off. And so, one way to when we talk about the labor market, it's hard to understand what to talk about when you talk about the labor market. It's such a large topic. It's such a big thing. You have wages, you have hirings, you have firings, you have quitters, you have just all the stuff you got to kind of take into account when you're figuring out what the labor market is. It's not just the unemployment rate. It's not just non-farm payrolls. And so the Kansas City Fed actually does a pretty nice job of taking a whole bunch of indicators, and this is this chart on the right. They take a whole bunch of indicators with respect to the labor market, and they basically distill it down into one number. And they do some fancy math to get there, but at the end of the day, like they're just trying to say, hey, what's the labor market picture look like overall in the United States? And like most charts, like green is good and red is bad. And we can see this is a labor market which is cooling. This labor market is it's certainly cooled off from the heights of 2021, 2022, but we don't want it to be that hot, because that hot was inflationary. Cooling off to a period where we stand right here is like, again, it's cooling but not cool. Like this is a very stable, sort of robust, kind of labor market indicator and labor market economy. And if you have the labor market right, if you have companies that are loath to fire folks, and people are generally reasonably well employed, that's just not an economy. That's not a labor market that cracks really quick, and that's not an economy that cracks really quick. So this is the top of the things that we look at every week and every month is things having to do with labor markets, because it is so important. We're just not seeing it yet, guys. Like we're not seeing the cracks. We're seeing some cracks in the labor market. We're not seeing anything that's really worrisome so far. And this is not an economy that you want to try to get ahead of. This is something where like, so long as things continue to chug along, you've got to participate, because the economy is going to continue to chug along right along with it.
Yeah, no, I mean, that's a great point. And Scott, I think that then goes to this concept of, okay, you've got an employed consumer. Why is that important? Well, that means that they're making money. And then in essence, they're spending money. So if we start to look at spending power, we think total payrolls, right, is a great way to kind of get an idea of spending power of that consumer, or their spending ability, if you want to think of it that way. And really, it's as simple as it's the number of workers times the number of hours that they've worked times the wages. And you start to look at year over year, growth. Where are you seeing that? And what you see is we're basically right in line with where we were pre-COVID, right? We talked so much about kind of that inflationary period. You see it in 2021, 2022, but then you see that same normalization that we've talked about on a couple charts now, really over the last 2-3 years at this point. And it's just getting back into that kind of normal growth rate, normal growth trajectory. And that's extremely important. As we say in the title, boring is good here. You're getting to a point where you've got an employed consumer that's making money, which means they're spending money. So that's a good thing for this economy at large. Scott, one last thing, and we touched on it a little bit. when we talked about AI, but this idea of, profit margins, profitability, productivity gains. Maybe talk us through this chart specifically, because it looks at two very different kind of periods of time within the U.S. economy, and why we think that's important as we head into 2026 and beyond, especially related to AI.
Yeah, look, I mean, like this is one of the most important charts in the deck this quarter, I believe, and it does, because I don't think people have an appreciation for how strong and how powerful the AI tailwind and the sort of technology tailwind has been for the United States over the last 30 years. Before essentially PC and internet revolution in the mid 90s, corporate profit margins in the U.S. basically just kind of hovered around 6%. I mean, they just didn't really go anywhere. They certainly cycled on, on and off with recession and everything else, but we just sort of stuck, like right around 6%. And then what happens? So then now we have sort of a dual technology takeoff, and which enhances productivity. That's starting in the mid 90s, and you can just see what happens with corporate profit margins since then. We've almost doubled over the last 25 years after having gone nowhere for the prior 50. And that's an incredibly important thing, because the thing that technology does, and the thing that and the internet PC stuff started, AI is continuing right now, but productivity drives profit margins, because again, doing more with less, that is margin expansion. And the thing we have to know about equity markets is that when you have profit margin expansion, that is an exponential impact on equity market values. It's not like gaining revenue growth, which is a linear impact. You get margin expansion, you have exponential impact. And so to the extent that you can get additional margin expansion through the use of AI or through productivity gains, as we've been talking about ad nauseum all day today, this is the most important thing you can figure out. If you get another point of margin expansion because firms have adopted and figured out how to use AI to expand margins, it's a massive impact on the S&P 500 valuation essentially. And so it's just understanding sort of this is the tailwind that you got behind us, guys. It's an important one. Let's recognize it and appreciate it.
No, that's a great point, Scott. And I think it then takes us into kind of the last section of today's deck. And all right, so we've looked at the data. Now let's look at the markets. And we've heard a lot about this Trump put idea. Scott, maybe explain what we're looking at here, because I do think it's extremely important as somebody's thinking about, okay, what does that mean for whether it's the back half of this year, next year, and beyond?
So, I mean, in order to understand this, we have to go back and remember what kind of how Trump 1 went. The first time Trump was in office, he was pretty vocal about caring about the market. And if you've got somebody in presidency that cares deeply about the market and tells you so, that sort of generates a feeling in the market and sort of trading behavior in the market that if things get too bad, they're going to come to the rescue. So everybody's heard about the Fed put that's been that's sort of like latent back there for the last 30 years or so. Trump put, what we thought we were getting in Trump 2 is going to be kind of another guy that comes in and says, hey, listen, I really care about markets. I pride myself on getting all-time highs. We want things to, we want people to get richer and so on and so forth. And I'm using the market as sort of a barometer for that. And that really got thrown into question with Liberation Day. I mean, the folks that he had rolling out to talk to the world were, Ladner and Navarro, that really don't care about markets at all, as it seemed when they're on TV. And the Liberation Day rollout obviously didn't go very well in terms of the market reaction to it. And people were like, "What do we got? Like what do we have with Trump? Does this guy care about markets anymore? Or is he going to kind of leave us in the dust?" And I don't think so. I don't really think he cared about markets per se that much. But what I'm showing here in this chart is approval rating, and not just approval rating, just like a generic sort of like real clear politics or something like that. Sort of taking an average. This is a Rasmussen poll. So Rasmussen is well known to be sort of the rightmost pollster. So if Trump's going to listen to any pollster, it's going to be somebody like Rasmussen or something like that, as far right as you can get, essentially. And this is Rasmussen's approval index, essentially, just daily from the sort of beginning of the year through the last couple of months. And the day that Trump turned on, basically, the day we had pause on the Liberation Day tariffs was when that was at the nadir of that approval rating, and then we started shooting back up, and obviously the market sort of followed. But I don't really think the market is necessarily Trump's the underlier for Trump's put. I think it's approval rating and as properly measured by something like Rasmussen. And so watching this, on a go forward basis, I think will give us a little bit better clarity as to like, what does this guy really care about, and what is really going to sort of drive changes in this policy or changes in direction in this policy. We're looking much more at something like this than we are at the 10-year rate or the S&P 500 level or something like that. At least for how we're thinking about the world right now in Trump 2.0.
No, that's a great point, Scott. And you talk about what we're looking at, and I think we touched on this idea of hard data versus soft data. I think this is a pretty interesting slide because it looks at that divergence that we talked about, and the fact that maybe that hard data, if you look at it, actually suggests that things aren't nearly as bad as the soft data would otherwise suggest.
Yeah, I mean, look, this is kind of putting in one chart the things we talked about for the first part of this webinar. I mean, all the fields part was essentially all the soft data stuff on the right side of your screen. Consumer confidence, sentiment, new orders. ISM is another survey-based thing. And we're saying, like, listen, all the fields aren't great. Like people don't love the world. They kind of don't feel great about it. It's not impacting how they're behaving from an economic standpoint. It's not changing their behavior. Either from a business standpoint or from a consumer standpoint, and that's sort of showing up on the stuff on the hard data, which is stuff on the left. This is like how do people's behaviors, how do policies feed through into the data that sort of drive the economy. And right now we're seeing hard data that are still holding up pretty well. I mean, certainly have softened some. I mean, we think this is kind of a 6 or 6.5 kind of out of 10 economy. That we're not screaming, but it is not falling off a cliff either, and it's certainly not at levels that would be consistent with the sort of the soft data readings that we saw on the right. The soft data readings were some of the stuff that really got people screwed up in 2022 and 2023 that were calling for the recession.
Well, and you talk about folks calling for a recession, and we wanted to just kind of remind people, right? There's always something to worry about. This looks at the last, call it 15 years, right? And at any one point in time during that period, there was something that was going to derail the economy, that was going to derail the markets, that was going to lead us into a recession. And what we've seen, chart on the right, is a market that's just grinded higher and higher and higher. Now, granted, right, you had COVID, right? You had a pullback there. You had, trade war, tariff conversation earlier this year. I'm not saying we haven't had pullbacks and we haven't had blips or periods of volatility, but what you see on the right is, again, there's always going to be something for us to be back of our mind worried about. That's not to say that we shouldn't be paying attention to it, but Scott, as you pointed out, we also have to go past just kind of that baseline data and really start to understand some of that harder data that we were talking about. I think this is a great way to look at maybe some of that harder data, Scott, is if we finished up Q1 earnings season, like it wasn't bad at all. And that was in the midst and the turmoil of Liberation Day, which had at that point been just 2 to 3 weeks prior. Scott, maybe like explain what we're looking at here and then why it's important.
Yeah, I mean, like it's and you guys, if you listen to us much at all the last several years, you've heard me say it over and over again. The starting point matters. The starting place matters, and the starting place for coming into Liberation Day and some of the uncertainty that was foisted upon us as a result of that, it was things were fine. From a corporate revenue standpoint, from an earnings growth standpoint, like things were, again, we're not screaming, guys. Like I'm not out there making an argument that we're screaming, but we're not falling off a cliff either. And the starting place for some of the turmoil and some of the uncertainty that was foisted upon us was fine. Like it was good, and that helps. Look, I mean, we weren't coming into that period of heightened uncertainty from a point of weakness or from a point of greatly declining strength. That was not the starting place for this stuff, and that has had a large impact for how quickly we've been able to recover as well, because we didn't have to kind of get back to even kind of square one. We just had to get back to where we were, which was a 6 or a 7 kind of thing, and it looks like we're hopefully on our way there.
Yeah. So Scott, we talk about earnings, right? You've seen continued, I don't know if strength is maybe a little too strong of a word, but solid, as we say in the title, earnings and growth for that matter. Quarter after quarter, but we continue to get questions. Well, man, these stocks are expensive. Specifically, there's a handful of stocks that are really expensive. Shouldn't we be worried about that from a valuation standpoint? I think this chart does a good job of maybe highlighting, maybe there are times to be worried about overvalued stocks, but stocks that have high valuations, sometimes they're that way for a reason, right?
Yeah, expensive for a reason is a big deal. That last part is a big deal. If you have a high valuation, but you are earning money hand over fist, like a lot of these companies are that make up that sort of the magic gray line on this chart. It's not necessarily a bad thing because you can grow into it and you grow into that valuation, and they do. Because their return on equity and return on assets are so darn high, that they deserve the valuations that they're getting. They deserve to be the price that they are. And these are the stocks that you think they are, guys. These are the max 70 kind of things. And I'm not saying that you don't have the sort of the buffer of safety that you would if they had a lower valuation associated with them. We saw what can happen in a year like 2022 when you have high rates, and we didn't know how high rates are going to go, and this really sort of pricked the high valuation companies, as historically something like that does. But like you're able to recover really quickly because your return, your fundamentals are so strong, your margins are so strong, your ability to generate revenue, and no matter what the economic backdrop looks like, is so darn strong and very unique in the world. And so just saying that you're an expensive stock doesn't make you a bad stock. We need to sort of take a look at, are you expensive for a reason, and do we think that reason is sustainable into the future? And for those that are earning these incredibly high return on equities, we continue to think they will, because we do think the AI thing is here to stay.
Yeah, and I think we made the comparison earlier to the internet revolution, right, of the mid 90s, and we've made this comparison in the past. We wanted to just highlight this, one more time, because we've shown this chart in the past. We've now shown it here today, and I think what you see is kind of that revolution impact, if you will, from a market standpoint. Scott, you touched on some of these companies from a valuation standpoint today are much further ahead of where they were in terms of actually earning money, bringing money to the bottom line, as opposed to where they were in the mid 90s. And I think that's important, because if you look at it, we're still middle innings of, potential market impact. Now, we all know how it ended in the late 90s, right, with the tech bubble bursting. But again, that goes back to companies that were being valued even though they weren't earning money. What we're seeing today is companies that are receiving those high valuations, and they're actually earning a lot of money, so rightfully so to some extent. So I think that's extremely important. Thought it was a pretty interesting chart to just, again, bring back up, because that's something that we continue to talk about when we look at the comparison to that internet revolution. Scott, we've touched on the tariff conversation a decent bit. One thing that we've gotten questions around is, the inflation conversation. Is that going to be a problem with Liberation Day? What are we looking at here? Why is that important? Is inflation going to be a real concern as we start to talk about Liberation Day? Like, what should we be thinking about there?
Yeah, look, the inflation question is important, and we've said it a number of times to a number of different clients. But in the medium and long term, tariffs or taxes are deflationary. So this is not tariffs do not cause long term inflation. They're actually retardant of long term inflation, because they're retardant of nominal GDP growth. And so from the longer term standpoint, we'll take a look at that in a second. There's really no inflation. There's really no inflation fears associated with tariff regime that Trump wants to put in place here. What we did need to worry about, though, was the short term dynamics, because sort of tautologically, there can be obviously price hikes. If you have input price hikes and you pass that along, that's obviously inflation. It's sort of definition of inflation. And so that can put somebody like the Fed in a tough spot, because just like in 2022, when the Fed was really unable to come to any sort of rescue, because inflation was so hot and so far above their target, they were unable to basically have the Fed put in play. They were not able to cut rates when growth started to weaken, and everybody really freaked out about that, because it's kind of the first time we're riding without training wheels for quite some time in this market. And so that's sort of the fear that people got worried about with Liberation Day. Is like, are we going to have a spike in inflation that's going to put the Fed on hold and kind of take them away from the sort of the safety game that we're used to having in the background of these markets? And so the point of putting this chart up here is probably not. Look, I mean, U.S. consumers and U.S. businesses are not dumb people. They can manage their business if you tell them we're going to raise prices, they're going to go out and front run stuff. That's what this is. Businesses imported a crap ton of goods really, really quickly. And this is a long chart. You can see behavior like this doesn't exist anywhere else in the chart. People front run these tariffs, and so that's essentially building a buffer. They build a buffer against the short term inflationary impacts. It wouldn't last forever, but it certainly can kind of get us through 3, 6, 9, 12 months worth of price hikes because because businesses basically front ran the tariffs before they were able to take effect. And that can be a really big deal for not only for sort of financial markets, but for the inflation outlook in the next 3 to 6 months, which can really kind of free the Fed's hands up.
So, Scott, you mentioned short term. I think medium to longer term, though, I think that's where probably maybe the concern existed. But to what you said earlier, it's probably something we shouldn't really be worried about.
No, we're not, and the market is not either. I mean, this is just basically how much does it cost to buy an insurance policy against inflation being higher than 3% for the next 2 years or for the next 5 years, and it doesn't cost very much money, and it didn't really spike at all after the Liberation Day stuff, and as it should, because and you can actually see that it's actually gone down a little bit over the last couple of weeks. It's because because just what the title says. Tariffs, taxes are deflationary. Medium to long term stuff should have no meaningful impact on inflation, other than to be like downward pressure on inflation, frankly, downward pressure on nominal growth. But it's the point of these two charts together is to say, listen, we think there might be sort of a short term fix for the inflationary pressures associated with higher tariffs, and there's really no kind of long term impact that the market is pricing in at all from the tariff policy. So we really just shouldn't be worried about it. We're not worried about it, and the market's not worried about it either.
Yeah. And so, Scott, you mentioned on that last chart, the fact that we've seen maybe inflation expectations come down marginally. I think this chart would highlight, like, that's something I think we could make the case that the Fed would actually welcome that at this point. It seems like, right, given where we were coming from over the last 3 or 4 years, inflation has stalled just above kind of that Fed target when it comes to inflation, which has made it really difficult for them to kind of consider cutting interest rates, right? And we all know maybe there's pressure coming from the White House, from the administration when it comes to cutting rates. And I think we'll eventually see rate cuts at some point, probably even this year. But I think the inflation piece stalling has been maybe one of the key factors as to why the Fed has at least been a little bit slower to act, right? They've been in an environment where inflation coming down has been a great thing in terms of getting back to that long-term goal. We're not quite there yet, and that's something that I think we continue to keep a close eye on, because I do think it goes hand in hand when it comes to future Fed activity, which then, Scott, brings us to this chart, which is almost comical as you start to look at maybe, is the Fed going to cut? Or are they not going to cut? And it just speaks to that word uncertainty again. There's so much out there in terms of, even from the Fed's perspective, as to like which direction things could go.
Yeah, look, the degree to which you find this chart funny is in direct proportion to the degree to which you are a nerd. And so, like, I find this hysterical. It doesn't say great things about me, but whatever. So the Fed has models about the economy. They have models about these big fancy math models. They're called dynamic stochastic general equilibrium models, or the word for the one in the U.S. is called FERBUS, the Federal Reserve Board of the United States. Long story short, these are kind of like stimulus response models where they say, listen, if I turn this knob one way, like, what does that do to inflation and growth? If I turn the knob this knob that way, how does that impact sort of inflation and growth? And usually, like, their estimates about what if I do something to inflation, or if I do something to tariffs, or I do something to taxes, like, how does that impact inflation and growth going forward? The band around their sort of point estimate is somewhat tight. And these are I don't think you just use the word tight as an adjective to describe this. So these are sort of the confidence bands they have about the Fed's own forecast, so their own math models about what, like, how much uncertainty is there in their point estimate of GDP growth and the point estimate of inflation, and it is comically large. I mean, look, having a 1 year out 50% confidence band for GDP growth of 20 percentage points, so like -8% GDP growth or positive 8, whatever, like, it's just ludicrous. And it's telling you that their model, like, they think their models are garbage. And the same thing for inflation. I mean, like, that confidence band for inflation is absurd. And so the other reason, to be really blunt about this, like, the other reason the Fed's not doing anything is because they don't have any idea what the policies are ultimately going to be, B, what their impact might be. And all you got to do is look at their own models to tell you that. Like, they're telling you with these ridiculous looking graphs that they don't have the foggiest idea for what the policies, the policy impacts are going to be on the economy. Therefore, how can you act? Yeah. How can you cut in an environment like that? If inflation is above target and your own math models are this just dumb, like, what are you gonna do? Like, what would you do? I would just, if I were able to, I would just kind of hold pat, and I would try to wait until my model became less dumb and less ludicrous. And that is what they are doing, to be perfectly clear. Now they are probably going to start cutting here. It's maybe September is kind of a coin flip, whatever. But it is they are not cutting because they don't have the foggiest idea, just like nobody else does.
Yep. No, I mean that's a great point, Scott, and I think it maybe goes hand in hand too with this last chart that we've got here as we start to talk about the Fed and the probability of what's going to happen, and what you're looking at here is what's the probability of the Fed cutting rates below 2.5%, which if the Fed has cut rates from where they are today to below 2.5%, it's probably a high degree of possibility that we're either in or heading into a recessionary environment. And I think what you see is basically we're as low as we've been over the last 2 years, less than 5% in terms of that probability. And again, Scott, it goes with what you were just saying. I think a lot of that comes from the fact that there's a lot of uncertainty in the environment around what that data is going to look like. Now, obviously, this can spike and could change if some of that hard data that we talked about earlier starts to change. But I think it paints that picture of, hey, where we're sitting right now, that probability of recession, the probability of the Fed cutting rates significantly or substantially over the next year is relatively low, which again goes back to a lot of what we've been talking about, just kind of the underlying strength of that data. Again, not a 10 out of 10, but a 6 or 7 out of 10. So Scott, we talked a lot about domestic policy. We've talked a lot about the U.S. economy. One thing that we haven't talked a lot about, honestly, and at this point it seems like years, is the international markets. And we've got a couple slides on here that speaks to maybe why now is at least a time to be thinking about or having a conversation about international equities, international markets, because we're seeing a phenomenon that we really haven't seen in some time.
Yeah, I mean, so this is essentially a chart. The line is the dollar index, and the green and the red is it comes from the foreign exchange options market. And essentially, when it's green, that's telling the options market is making it expensive for to bet on the dollar going up. And when it's red, the options market is making it expensive for to bet on the dollar going down. You can see how often the market makes it expensive to bet on the dollar going down against a kind of a broad swath of currency. It doesn't happen very often over the last, really, since great financial crisis, and for good reason. I mean, the dollar has generally been pretty strong for most of the last 15 years or 16 years since the financial crisis. That's changing. It's changing. So like as of the last month or two, the option market has started to make it more expensive to bet on the dollar going down. Which you should note, because there's a lot of money a lot of smart money that plays in these markets. And so if that is sort of what the options market is telling you, at least it should be back in your head that maybe these guys are onto something. Like maybe we do need to pay attention to the idea that the dollar may be going down. And the next slide is like, and that matters. Now look, I know this is a ludicrous chart with this is probably like the worst chart I've ever put up on anything. So apologies in advance, but the point I'm trying to get across from all these lines and arrows and everything else was pretty simple. If the dollar is going up, that is a big tailwind to U.S. stocks outperforming internationals. The dollar is going down, it's a big tailwind for international stocks relative to U.S. We haven't had that period since kind of the mid 2000s, and that is that. This is. I'm not saying this is that period. There are big differences between what was going on back then and what is going on, what we think right now. In terms of flows and GDP growths and a bunch of different things. But at the end of the day, we do think we're entering a period of modest U.S. dollar weakness. And it started earlier this year. We actually talked about this in our January webinar earlier this year. We do see some of the signs, and we do see some of the reasons why the dollar might go through a period of modest decline. We don't think it's going to be sort of disastrous or really, really large, because you still have growth differentials in favor of the U.S. You still have rate differentials in favor of the U.S. And you still have all the technology and all the AI companies that are basically kind of U.S. centric. So the drivers of global growth are also centered in the U.S. So this is not like a period like the mid 2000s where equity markets are dominated by financials and industrials and oil companies, things like that. Things that basically Europe and Asia could play really well in. Europe and Asia can't play really, really well for the most part in the sort of the growth centers and the sort of the market centers of this decade right now. So there are differences to this stuff, but Don't sleep on the point that if we are entering a period of modest dollar weakness, that is going to be a tailwind for international stocks relative to U.S. and we think that's going to continue for several quarters, if not years.
And Scott, there's not a little amount of money that would potentially be in motion if that's the case, right?
Yeah, I mean, look, it's the thing that we think is probably driving this so far this year, and was likely to drive it sort of be in the driver's seat. If it's not going to be growth differentials or rate differentials or some of the other sort of standard classical kind of theoretical reasons why the dollar would go up or down, flows can matter a lot, and flows with respect to hedging the U.S. dollar exposure by foreign holders of U.S. financial assets, of which there are $30 trillion worth of U.S. financial assets held by people that don't live in the United States. If those folks decide sort of en masse that they need to start hedging a little bit more of their dollar exposure, which we think is probably a wise thing to do, because the dollar and risk assets has not been a very stable or kind of normal relationship in 2025 relative to the past several years. But ultimately, if those folks decide that they want to start hedging dollars or hedging the dollar exposure in their portfolios, that means that they have to sell dollars. That means that the flow of funds is negative for the dollar against most other currencies. We think that's been the sort of in the driver's seat for so far this year. It's really hard to get data on this stuff, but that's what we believe to be the case. And if that is the case, that hedging activity doesn't tend to just last a quarter. These things tend to have kind of long tails, and they go on for a little while. This could go on for quarters and years, and just have a sort of a modest, just a modest downward pressure on the dollar for a while, emanating out of these hedging flows.
No, that's a great point, Scott. All right, we've got one last slide, and really just kind of want to bottom line it. So if someone were to just watch this entire webinar, skip to the end of this webinar, this one slide kind of gives you a bring home point. Is what are we looking at? What are we looking for the next 3, 6, 9 months when it comes to the markets? We're looking for continued solving of that uncertainty piece that was really dropped on us earlier this year. And again, this is a chart that looks at Bloomberg's Global Trade Policy Uncertainty Index, maps it right against the S&P 500 Futures Index. And again, you see just how tightly correlated they are. And I think that's something that we've continued to hit on time and time again, is this concept of uncertainty really threw folks for a loop, threw the markets for a loop earlier this year. But you've seen that get better and better just over the last 3 months. That's something, though, that we're not out of the woods yet. I think that's something that we're watching very closely when it comes to, are there future actions that take place? Are there additional bills that add uncertainty into the marketplace? Those are all things that we're watching for. And Scott, you touched on it earlier, this concept of, the tariff trade war conversation was very much so man-made in terms of the release of that and the timing of that. These are all things that can be unman-made, as we've talked about. So that's something that, again, we're paying very close attention to as we look into the back half of the year. We've got a slide here which hits on a few key takeaways. I'll leave these up here, Scott. There have been a handful of questions that come in, and I'll really group it into kind of 2 specific questions. One, first one, Scott, was around the big beautiful bill, right? The tax bill. Do we have any long-term concerns with the increasing deficit? If so, what are they? And maybe the second part of that question is, are there any investment implications that come out of that big beautiful bill?
Yeah, I mean, look, yes, are there concerns about long-term budget sustainability? Of course there are. Is there anything to be done about it? No. There's just not nobody wants to tackle it. I mean, the only way you tackle it is by going after the entitlement stuff, and who's going to do that? So we don't have that. The thing we also don't have is a crisis. And the thing we also and the thing that we can't predict is a crisis, because predicting crises is like you can't get it right. You can't predict it ahead of time because you don't know what the sort of breaking point is for the market. We saw this in UK a number of years ago with Liz Truss. Where she came out with a budget like nobody believed it. And the market just puked all over it, and what they did is they sold the currency and they sold the bonds. They sold gilts. They sold UK treasuries, and they sold the currency. That's the I don't believe you trade. So if we get a situation where U.S. treasuries get drilled, go way down, rates go way up, and the dollar goes way down at the same time, that's the I don't believe you trade. That happens in emerging markets sometimes when people don't believe policies coming out of emerging market economies. It has never happened with the reserve currency of the world. It has never happened with an economy the size of the United States. And so it'd be stupid for me to sit here and say, like, yeah, I can tell you the date on which that's going to happen, or here's the line that cannot be crossed in terms of the budget that the market will magically care about. I can tell you that in advance. Anybody that's telling you that is selling you a bill of goods. Like, that's just a ludicrous thing, because predicting that which has never happened before is impossible. So we can watch for it. I know what the signs are. The signs are, you get the currency getting creamed, and you get treasuries getting creamed simultaneously, and not like on a day, like on the, this has to go on for a little bit.
Yeah.
You see that? That's the market telling you that we don't believe you, we don't like your policies, and there's going to be a reckoning of some kind. Until or unless, you just can't predict that which has never happened.
Nope, makes a ton of sense. Last question. We got a couple kind of different versions of this, but came over is, obviously we're not forecasting, predicting, whatever you want to call it, a recession as we look forward over the next 3, 6, 9 months. But folks are asking, what should we be looking for as to when maybe a recessionary environment starts to creep into the horizon? Is that, is there a specific data point? Is there something in the labor market? Like, what is it that we're watching or that they should be watching when it comes to data that would maybe help kind of forecast a recessionary environment?
Yeah, I mean, to us right now, at least the things that we see out there, it would be the labor market. And so, if people start losing their jobs, if people start getting fired, and I'm not talking about like labor market that's softening because the hiring is slowing down. If firms are actively shedding jobs, if they're actively firing people, that's telling you that they see something out there that is that's untenable, and sort of dangerous. And when people start losing their jobs, like, this doesn't go like super slow and super kind of super linear. Like, you heard this before. Like, job change stuff and labor market changes tend to be nonlinear. And so I think they can get away from this reasonably quickly. That's why we spend so much time looking at labor market data and trying to analyze and understand it and see kind of what's going on in the inner workings of it. We're just not detecting anything that is really scary right now. But if I were to watch something, the thing that keeps me up at night, sort of question, is like, you just get like a rash of firings. Like something happens in the economy, like the uncertainty finally hits, and like the wait and see kind of approach that corporations have taken ever since some of the Liberation Day policies, like, they don't understand what's happening, they don't know how to operate. If that stuff persists for long enough, and you just get sort of this organic sort of wave of firms needing to shed jobs, like, yeah, that's then you're gonna get a recession, guys.
Yep.
But until or unless you get something like that, it's going to be really tough, because it's really tough to get a recession, because you don't have leverage in the corporate sector, you don't have leverage in the personal sector. You do obviously have leverage in the government sector, but that's a totally different story. And things are sort of humming along right now. So this is one where we're watching and being vigilant. Is always a smart thing to do. But in terms of seeing something right now that really, really worries us, and it would start in the labor market, and we're just not seeing it today as we sit here.
No, great stuff, Scott, and really appreciate you taking the time to hang out with us and walk through all this today. For anybody that had questions that didn't get answered, or maybe have questions after hanging out with us this afternoon, please don't hesitate to reach out, whether that's to your regional director, whether that's to our sales desk here at the firm, whether that's to a strategist that you work closely with here on our portfolio strategy group. Any and all of those folks would love to have continue the conversation when it comes to our view on markets and our outlook. I'd also say this: if those of you with a keen eye for design, if you've been paying attention, you've noticed a slight difference in the Horizon brand. We rolled out a new brand earlier in June. We're really excited about that. If you haven't seen that, I'd encourage you to head to our website. Our dashboard that's got all our tools on there. Both of those have been completely rebranded. So exciting to roll that out, and just focused on the financial advisors that we're working with. Fueling your growth is something that we're really passionate about, and empowering those advisors that we're working with. So excited to continue to do that. The new brand, I think, speaks to that goal and that mission that we're focused on. So again, please don't hesitate to reach out. Really appreciate you taking the time today, and look forward to having those conversations with you in the future. Thanks so much.